Welcome to the Deep Dive, your shortcut to being well-informed.
Glad to be here.
Today we're diving into TRZOO, that's ticker TRZOO, as part of our TalkTickers segment. We're looking at their second quarter 2025 earnings call.
Right.
Now, if you just glanced at the headline numbers, you might see profitability taking a bit of a dip.
Yeah, it looks that way initially.
But that's really only part of the story, isn't it?
Absolutely. What we're actually seeing is a company making some very deliberate strategic investments.
Investments designed for the long haul, right, for significant long-term growth.
Exactly. Even if it means, the short-term financials look a little different.
Okay, so let's get the snapshot first. What did the key Q2 figures look like?
Well, the top-line revenue, that looked pretty solid. Consolidated revenue was $23.9 million.
And how does that compare year over year?
That's a good 13% increase.
Yeah.
In constant currencies, it was $23.5 million, so up 12%. Strong growth there.
Okay, solid revenue growth. But you mentioned the profit picture tells a different story.
Yes, that's where the strategy really shows. Operating profit, or operating income as management calls it, that decreased.
Decreased to what?
It came in at $2.1 million. That's about 9% of revenue, down from $4 million in the prior year.
Wow, quite a drop. And they link this directly
to increased investment, specifically investment in member growth. That's the stated reason.
Got it. And what about their adjusted profit figure, the non-GAAP number? Does that smooth things out?
It shows a similar trend, actually. Non-GAAP operating profit was $2.4 million, or 10% of revenue.
Compared to
$4.8 million last year. So, yeah, a similar dip.
And that flows right down to the bottom line, I assume, impacting earnings per share.
It did. There was a reduction of 13 cents per share for Q2.
Okay, 13 cents. Now, for a lot of people listening, an EPS hit like that is a bit of a red flag. What was the immediate explanation?
They were very clear on this. They put it down to the accounting treatment. Specifically, how they account for member acquisition costs versus how they recognize the revenue from those members.
The timing difference. We'll need to dig into that. But first, what about their cash situation? Did these investments drain their reserves?
Not really, no. They still have a solid cash position. As of June 30th, consolidated cash, cash equivalents, and restricted cash totaled $11.2 million.
And cash flow?
Cash flow from operations was positive, $1.3 million. They also managed to reduce merchant payables by about $2.44 million.
Okay.
And they even bought back some stock, 172,088 shares during the quarter.
So financially stable, despite the lower reported profit, management's message is basically, this isn't a problem, it's a plan.
Pretty much. They're emphasizing it's a deliberate, calculated move, part of a specific long-term strategy.
Okay, let's unpack that strategy then, this calculated maneuver.
Okay.
What's the bigger picture here driving these numbers?
The core really is this aggressive push for new members, acquiring new club members.
So they cranked up the marketing spend?
Significantly.
Yeah.
And they were explicit about it. The goal is to get new members and push TRZOO into what they're calling high growth mode.
High growth mode. Okay. But aggressive spending only works if the return is there. What makes this investment so compelling for them?
It comes down to the unit economics. They are, frankly, quite favorable.
Okay, walk us through those numbers. What does it cost to get a member, and what do they get back?
So in Q2, the average cost to acquire a full-paying club member was just $38.
$38. Okay.
Now, here's the kicker, as you might say. That cost is almost immediately offset. They get an immediate payback of $58 per member.
$58 back right away for spending $38. How does that break down?
Well, there's the $40 annual membership fee the member pays.
Right.
Plus, on average, that new member generated an additional $18 in transaction revenue within the same quarter.
Wow. So $40 plus $18, that's $58 back immediately.
Exactly. And remember, that $58 payback doesn't even count future membership fees, renewals, or any advertising revenue these members might generate later on.
So the economics look fantastic. Why the short-term EPS hit then? This must be the accounting piece you mentioned.
Precisely. It's all about timing. Those acquisition costs, the $38 per member, they get expensed immediately, hits the P&L right away in Q2.
Okay.
But the revenue, that $40 membership fee, that gets recognized ratably, spread out over the full 12-month subscription period.
Okay. Like they only count 1/12 of that $40 fee as revenue each month.
Exactly. So you spend the $38 now, but you only recognize, maybe $10 of the fee revenue in that first quarter? $40 divided by 12 months times 3 months in the quarter.
Right. So the costs are front-loaded, the revenue recognition is spread out. That explains the temporary dip in profit and that 13-cent EPS effect.
Correct. But while it hurts the short-term reported profit, it's simultaneously building up a really substantial deferred revenue balance on the balance sheet.
Which represents future predictable recurring revenue?
Exactly. It's setting them up for future quarters.
It sounds like management is incredibly confident about this. Any hesitation about continuing this, given the EPS impact?
Absolutely none whatsoever. Their commitment seems unwavering. They explicitly stated they'll keep investing heavily as long as this ROI stays this favorable.
They must really believe in it.
They do. In fact, they basically said they'd be stupid not to do so, which is pretty strong language for an earnings call.
It is strong. So you see the ROI, they're hitting the accelerator.
Yeah, though they did add a caveat about maintaining that ROI with a cool head. So they're not just throwing money wildly, they're watching the returns closely.
Makes sense. Smart growth, not just growth at any cost. Now, where is this investment concentrated? Is it across the board? Or are certain regions seeing more focus?
Well, the revenue growth itself was pretty broadly distributed across all segments.
Okay.
But interestingly, they noted particularly strong ROI on member acquisition in the UK.
Ah, so they doubled down there.
It seems so. They focused a significant chunk of investment there, which consequently actually caused their Europe segment to report an operating loss for the quarter.
A loss, just from that focused investment spend.
Yeah, because those acquisition costs hit immediately, pushing that segment temporarily into the red. North America also saw its operating profit decrease, reflecting the investment push there, too.
Interesting. Despite those regional dips driven by investment, I saw Jack's Flight Club mentioned. How's that performing?
Yes, Jack's Flight Club seems to be, well, flying high. Revenue was up 33% year over year.
33%, nice. And subscribers?
Premium subscribers grew by 15%. They attributed this mainly to past investments finally paying off, plus a price increase they put through back in Q2 of last year.
Okay, good momentum there. If we look at TravelZoo's overall revenue mix now, how does it break down between the traditional advertising commerce and these growing membership fees?
So advertising and commerce, the traditional business, brought in $20.9 million.
Yeah.
And membership fees, fueled by this new push, increased significantly to $3 million in the quarter.
$3 million. Still smaller, but growing fast. And that seems like the key figure for the future.
Absolutely. This is where it gets potentially transformative for them. Management is projecting that these recurring membership fees will make up about 25% of their total revenue next year.
A quarter of the business from recurring fees. That's a big shift.
Huge. And that shift is expected to drive a substantial increase in overall profitability. The recurring nature, the higher margins on subscription revenue, it could really reshape their profit profile.
So who are they targeting with this membership? Who's the ideal TravelZoo Club member?
They describe them as affluent, active travel enthusiasts, people open to new experiences, but also looking for significant value.
So not necessarily budget travelers, but value-conscious luxury seekers.
Kind of, yeah. They want TravelZoo to be seen as the must-have membership for this group.
And what makes it must-have? What kind of offers are we talking about?
They gave some pretty enticing examples. Things like cooking with a Michelin star chef in Tuscany.
Nice.
Luxury escapes like overwater villas in the Maldives or adventures in Iceland. Really unique experiences.
Beyond just deals on standard hotels or flights.
Exactly. Though they also highlighted practical benefits like worldwide complimentary lounge access if your flight's delayed.
Oh, that's a good one.
Apparently. They mentioned one member had already registered over 50 flights for that benefit alone.
Wow. Okay, so it's a mix of aspirational travel and practical perks, providing outstanding value, as they put it.
That seems to be the core driver for attracting and keeping members, yes.
And looking a bit further out, any updates on TravelZoo Meta or other big strategic pushes?
TravelZoo Meta is still bubbling away. They said they're working on producing the first browser-enabled metaverse travel experiences.
Browser-enabled. Interesting. Not requiring VR headsets necessarily.
Seems that way. And they emphasize doing it in a financially disciplined way. No blank checks there.
Good to hear.
Whoop.
And the broader focus.
Remains consistent, really. Keep growing paying members, convert legacy members, add new benefits, protect the profitable advertising side, and accelerate overall revenue growth. The growth that ultimately drives future profits, even with these temporary EPS bumps along the way.
Right. So let's zoom out a bit. How does this strategy fit into the wider travel industry right now? What are the current trends?
Well, interestingly, the backdrop is one of generally softer demand. We're seeing prices for both flights and hotels trending downwards in North America and Europe.
Okay, softer demand. Doesn't that usually hurt travel companies?
It can, but for TravelZoo, this dynamic actually creates opportunities. It allows them to acquire what they call distressed inventory from suppliers at really good prices.
No, so hotels with empty rooms or airlines with unsold seats are more willing to offer deep discounts.
Exactly. And TravelZoo can then package these into those really compelling, high-value club offers we talked about. It lets their members get luxury experiences for less.
That's a clever way to leverage a downturn, or at least a softening. What about consumer behavior? Are TravelZoo's members, who you said are affluent, starting to trade down, cut back?
Management was quite clear on this. They have not observed any trading down among their member base.
Interesting.
Instead, they see members using TravelZoo's deals to, quote, achieve more with less. So, still taking those nice trips, but getting better value through the club.
Makes sense. What about the general industry outlook? Are suppliers feeling confident long-term?
The sense is that the industry is quite short-term focused right now. There's a general feeling of uncertainty, global environment, politics, potential administration impacts.
So people are hesitant to make big, long-term bets or predictions.
Seems that way, which, again, might play into TravelZoo's hands if they can react quickly to short-term inventory opportunities.
This really does crystallize that trade-off, doesn't it? Growth versus reported profitability.
Absolutely. They are deliberately choosing aggressive, high ROI growth now, accepting the short-term EPS hit.
Because the math works out long-term.
Because the math, based on those unit economics and the shift to recurring revenue, is designed to lead to much higher margins and profits down the road, especially next year as all that deferred revenue from this year's member acquisitions starts getting recognized.
It's a classic invest now for future returns play.
Precisely. One thing they did mention regarding data transparency is that we won't get really solid, comprehensive data on member renewal rates until the beginning of 2026.
Because most current members were converted from their old free legacy membership only at the end of 2024.
Exactly. So we need a full year cycle to see how well the paid membership retains people. That'll be a key data point to watch.
Definitely. And speaking of the membership, they also touched on the price, right?
Yeah.
It's currently $40 a year.
Yes, a single tier at $40.
What's their thinking there? Seems low for the kind of value they're describing.
Management seems to agree with you. They openly acknowledge that $40 is likely too low, given the value.
So a price increase could be on the cards.
They said they plan to evaluate a potential increase for 2026. That would obviously be another lever to boost profitability quite significantly.
Okay, fascinating dynamics at play. Let's shift gears slightly. This is the deep dive, and just a reminder, what we're about to discuss is purely for illustrative purposes. It is absolutely not financial advice.
Got it. Clear disclaimer. All right, so imagine I'm pitching this to an investment committee.
Oh, lay it on us.
My idea. Initiate a strong, long position in TravelZoo, TRZOO. The thesis is straightforward.
Which is?
The market is misinterpreting, maybe even overreacting to this short-term EPS noise. People are focusing too much on the temporary dip.
And missing the underlying story.
Exactly. They're failing to fully appreciate the power of the unit economics behind this member acquisition strategy. And, crucially, the shift to a valuable recurring subscription revenue base.
So the argument is the market sees a travel company with lower profits, but you see a subscription business being built.
Precisely. Look at the numbers again. Spending $38 to get $58 back immediately. That's not just good, it's exceptionally strong, sustainable economics. It validates why management is so confident in pouring money into this.
And that investment is building.
A substantial future revenue stream. Remember, membership fees are projected to be 25% of revenue next year. That's a significant high-margin recurring base.
And you mentioned their ability to use the softer market to their advantage.
Yeah.
Getting distressed inventory.
Yes, that's a unique competitive edge right now. While other travel players might struggle with softening demand, TravelZoo can actually leverage it to create those super attractive club offers. It sets them apart.
So the outlook, the catalyst for the trade.
I'm anticipating a significant re-rating of the stock as the market wakes up and starts valuing this growing pool of recurring revenue more appropriately.
Like a sauce company almost.
Sort of, yeah. As they recognize the long-term margin expansion potential, especially when we get that retention data in 2026, and if they raise a membership fee, I think the stock has room to climb significantly.
So the bet is on the market, eventually seeing past the short-term accounting noise and valuing the underlying subscription model.
That's the core of it. It's a bet on high ROI growth and the compounding power of subscriptions.
Okay, quite the compelling pitch. Let's recap our deep dive on TRZOO's Q2 then.
Sounds good.
The core message really seems clear. TRZOO is making a very strategic, aggressive bet on building a recurring revenue stream through member acquisition.
Even though it causes a temporary but deliberately planned hit to short-term earnings?
Right. But the expected long-term payoff, significant margin expansion, growing profitability driven by those recurring fees, that's the prize they're aiming for.
That's what management is banking on, yes.
Okay. And remember, everyone, our discussion today, especially that trade idea, is purely for informational purposes. It is not financial advice.
Please consult a professional before making any investment decisions.
Definitely. But it does make you think, doesn't it? How companies across different sectors weigh that balance. Short-term results versus long-term strategic investments, especially with subscription models.
It's a constant tension. How much profit today versus how much growth and potentially much larger profit tomorrow?
Something to consider in the industries you follow. We'd love to hear your thoughts or questions for future deep dives.
Yeah, absolutely.
Until next time, keep digging into those numbers.